My name is John Rowland, Bar Chart's Head of Trading Education. Welcome back to another episode of Rowland's Trading Roundup, where you can better learn about the features and tools that Bar Chart has to offer. If you're new here, hit the subscribe button to get alerted anytime we upload a new video. Before we jump in, please take a moment to pause the video and read this important disclaimer in full. Any decision to buy, sell, hold, or trade any investment involves risk and are best made on the advice of a qualified financial professional. Today's subject, 2022, new year, new trends. So I really believe that 2022 will be one of the most challenging years for stock pickers in over a decade. And that's because of a myriad of cross currents between these emerging trends. So if we look at the economic cycle, there are certain sectors that do outperform other sectors during the different economic cycles. For instance, in the early cycle, typically after a sharp rise, we see a sharp rise after a recessionary session, consumer discretionaries, real estate, finance. So if you think about last year, real estate was one of the outperformers, and the previous year we did have recession that was a reaction of COVID. But again, I think this is more of a dynamics of demographics in terms of folks that were living in cold states that were moving towards warm states. And certainly in my personal experience, I moved from Pennsylvania to North Carolina. But financials, right? Maybe we weren't in a recessionary cycle last year, or certainly a lot of corporations did very well last year. But financial stocks could have been in a recessionary cycle, right? Banks, right, because of low interest rate environment. So now we're seeing a change in that. So they could be in the early stages of their economic or business cycle. Mid-cycle, we see information technology, semis, industrials. Late cycle, economic activity surges or peaks, but corporations warn of headwinds and slowing growth. And if you were paying attention to what was going on in the earnings season in the last part of last year, many corporations were telling you that they had record profits or record earnings. And yet they were also saying that looking forward, they were starting to see inflationary pressures, input costs, in labor costs, and that they were warning that their earnings might not be as profitable as they had been in the past. But we see energies and utilities are those two sectors that tend to outperform in late cycle. And certainly energy was one of the sectors that outperformed last year. And then finally, we move into what is called the recession cycle. Excuse me. Economic activity contracts, profits decline, and recessionary cycles tend to last a few more than just a couple months, maybe 8 to 10 months, sometimes maybe more than a year. And those sectors that perform well in a recessionary cycle are consumer staples, healthcare, and high dividend yielding stocks. So let's go to the tape and let's see if we can find out what sectors are outperforming and see if we can connect them with our trends and our economic cycle. So here is our stock market and sectors performance page. And what this is showing us is the percentage of large cap stocks above their moving averages. And what we can see here for the S&P energy sector, 100% of all the stocks that are in that sector are above their 5-day, their 20-day, their 50-day, 100-day, 150, 200-day moving averages. And when we think about moving averages, price tends to stay above a moving average in an uptrend. So what we're seeing here is that energies is showing us that is in a strong uptrend through all time frames. But also we can look at what other sectors are performing well. Certainly financials. Again, we can see that about 80% of all the financials are above their moving averages. If we look at, for instance, consumer staples, yeah, in recent days, we see only about a third are above their 5-day moving average. I'm not concerned about that. Could be just a short-term correction. But if I look at 20-day all the way to 200 days, again, a large percentage, over majority of the consumer staples are above those moving averages. One other way we can use this grid in helping us to find what sectors might be moving in a positive direction or gaining momentum is we can look at the difference of percentages from longer term to shorter term. So for instance, look at communication services. Here what we see in the longer term moving average is that a majority of stocks are actually below these. In other words, here it says only 30% or about a third are above their 100 and 200-day moving average. That means 2/3 are below. That is typically a bearish indication or a sign that those stocks could be in a downtrend. But in the short term, what we're seeing is that the 5-day and the 20-day, now we're seeing a greater number of stocks above those moving averages. So what this is indicating to us is in the short term, this sector is gaining momentum. Maybe it's starting to turn around. This could give us onus to start investigating this particular sector, maybe looking at the stocks that are in there and seeing if they're benefiting as well from whatever trends we are discovering. So this is one way we can use this grid, not only to identify which sectors are strong and are trending, but also which ones that could potentially be changing trends or gaining momentum. I hope this video was informative. If you enjoyed today's content, make sure you subscribe to our channel and give this video a thumbs up. Until next time, the good of all trading.